But let's ask Pankaj Murarka, what does he propose we do in this market? Pankaj, hi, good morning. Great to have you on the show. Pankaj, what a mammoth volatile news flow and what a mammoth volatility in terms of oil prices, what some of the other asset classes like gold are doing, and the weakness that Indian equity markets are seeing right now. What's the advice to the investors out there, Pankaj?
Well, Aisha, it's very difficult to make sense of these markets and more importantly, what's happening in the world on an everyday basis. Things are changing on an hourly basis. If policymakers globally switch, their decision making or make decision instinctively, then I don't think so. Anyone can do anything about it. I think it's time we should hold our breath and stay calm. I think yes, oil price is an energy shock to India. We cannot deny that. And even if the war stops, given the damage that has been done to oil infrastructure, obviously it's very apparent now that post-war, whenever this war ends, let's say in the next few weeks, a few days or few weeks, oil prices will settle at a level which will be much higher than where it was prior to 28th of February. So there's a price to be paid for India, or there's an impact on India. But having said that, I think two things are important. One, India's macroeconomic fundamentals are very strong and very resilient. India can deal with it. And more importantly, the medium term and long term India growth story remains very strong. India is one of the very few economies in the world where we have a very large domestic economy and we can weather external storms, and the domestic economy itself can be a big driver of growth. Not many countries in the world have such a strong, resilient, robust domestic economy. So in times like this, when the external world is challenged, I think India is cushioned to that extent. So I think, and obviously from a market's perspective, given the kind of steep correction that we have seen in the last 4 or 6 weeks, obviously has made a lot of stocks or businesses very attractive from a slightly more medium term to longer term perspective. Because always bear in mind, markets are short term discounting machines. They're discounting the near term prices and the earnings over the next 2, 3, 4 quarters. They're not looking beyond that. Some of those businesses can have some impact on their near term profitability over the next 2 to 4 quarters, but I think the long term prospect still remains very exciting. And obviously, for long term investors, this becomes a great opportunity. So I think it's very important for investors to tide over this volatility as the world navigates this crisis. And I'm sure, like everything else, probably this crisis will also come to a close. And I think India has the ability to deal with this. So I think for longer term investors, this is a great opportunity to buy stocks with a longer term perspective and not get too swayed by short term volatility. But in the near term, probably until we get a final resolution, probably things could remain volatile.
Are they though, Pankaj? You think at these current prices, the markets have discounted the oil impact on earnings already?
Well, depend. Actually, we don't know what the new normalized oil price is. If the base hypothesis is that the new normalized oil price is about 80, $85, which effectively means about a $40 billion impact for India, and which is effectively about 1% of our GDP. I think that is by and large, in my framework, my top-down framework, that is by and large priced in. Now, if that oil price moves from $85 to $100 or $120, then that changes the equation. So it really depends on what really the new normal oil price is. My assessment is probably 80 or 80, $85 the new. In that context, yes, I think markets have priced that in.
Look at in that case the impact on second order companies which are dependent on crude derivatives or feedstocks which are coming out of crude. Do you see a margin compression coming into those companies then?
Definitely, Sajit, I think that will play out. So the headwind that India faces is this year has been a year of low earnings growth for India, where the aggregate earnings growth for, let's say, the top 200 companies is just about 6, 7%. And this is in contrast to some of the other economies in the emerging markets like Korea, Taiwan, which are delivering very strong earnings growth in the context of AI-driven growth that these economies are witnessing. With the oil headwind now in place, yes, that will certainly have an impact on next year's earnings growth. So before this war started, probably markets were pricing in and expecting, about 12, 13% earnings growth going into the next year from 6, 7% this year. And I think that number changed. We could again be in for a single-digit earnings growth at the aggregate level, at the index level next year as well. So which effectively means the first half of next year, when the pass through of this high cost inflation that companies are facing, probably they'll take some while to pass it on. You cannot do price hikes completely because the price inflation that companies are facing is very significant. It takes a while to pass it on, probably at least couple of quarters, if not more. In which case, the first half of next year can again remain headwinded in terms of earnings growth. And I think to that extent, markets, my assessment is markets have by and large priced that in.
Do you look at earnings growth? You spoke about the fact that earnings growth would be in single digits. What are you penciling in terms of earnings growth? And as a result of that, the P multiple for the Nifty?
Well, Sajid, it's very difficult to get an exact handle because as we speak, companies are busy dealing with crisis on a day-to-day basis. They're busy trying to fix their supply chain. They're trying to fix their inventory and everything else. No one know. We're dealing with a lot of uncertainties and things are changing on an everyday basis. We saw, oil price corrected all of a sudden by $10 yesterday. So in this kind of environment, no one can plan one's business and outlook becomes a somewhat hazy from a near-term perspective. But obviously, all of us know that some point of time things will settle down. Once things settle down, it's easier for businesses to plan and execute that plan in a normalized business environment. Today, the environment is not normalized given whatever is happening. Apart from price, there is a significant risk in terms of availability of fuel or gas, and supply chains are at risk. And all of those things are clearly playing out. But all of us know these are probably this will probably not sustain beyond a few weeks or few months, and I think we all expect things to normalize beyond that.
I think
In the
Sajid was just
context
trying
where
to
we
get in the
are,
worst case scenario from you, Pankaj. What's the worst case scenario that you're building in for a multiple on the index?
I think let's put it in this way. This year we're ending with about 1,050 rupees on Nifty earnings. So markets are about 22, 23 times trailing earnings. The worst case could be that we end up with a 5-6% earnings growth for the Nifty, and probably I think at 21 times, if that be the case, then markets are pretty much in line with our average multiples for the last 15, 16 years at 20 times, 21 times 1 year forward earnings. So markets are very much close to our mean valuation that we've seen over the last 15, 16 years. And any incremental improvement will be a positive trigger for the markets.
That would be around 20 times earnings for the index. Isn't that a premium for compared to other international, or other countries where the valuations are much cheaper?
But that's true. That is true. India is at a premium to other emerging markets, but that's always been the case. India has always traded in the last 25 years at a significant premium to other emerging markets because I think the world acknowledges that outside of US, within the emerging markets, India is the only secular growth story out there. Every other emerging market is cyclical. Last few years, let's say last 2 years, Korea, Taiwan, some of these markets have done well, but they're very much they have very high linkages to the tech cycle in US, and last 18 months have been driven by the AI investments that have been happening. Otherwise, every other emerging market is cyclical, and probably India is only long-term secular growth story. So, which is why India has always had traded at premiums which are between 40 to 60% to MSCI emerging markets. Even today, as we speak, India is about at 45% premium if you see in terms of valuations to MSCI emerging markets, which is pretty much in line with India's long-term averages. So I think that India will continue to enjoy, given the long-term growth visibility, India will always trade at premium.
Okay. Hi, Pankaj. Harsh joining the conversation. Give us a sense, therefore, what's the tilt looking like? Of course, in this entire 14-15% correction we've seen, some sectors would be disproportionately impacted versus others. What are the opportunities with regard to portfolio churn that you're taking as a result of this correction?
Well, I believe that we have a fiscal stimulus coming sometime in the middle of the year. I think the Prime Minister acknowledged yesterday in the Parliament that this crisis is akin to COVID crisis that India did witness, or the world experienced in India also. So I think probably I would double down on both one domestic economy because across consumption, autos, and financials, which have been hit pretty hard in this correction. And at the same time, I've been fairly positive on IT. I think the AI-driven sell-off that we saw in IT stocks a few weeks back was somewhat overdone. And I think I am a firm believer that AI is an enabler for IT sector. It will accelerate growth for IT companies in India. And a lot of these companies are now are trading at dividend yield, which are like 4 to 5%, which is make some of these long-term growth stories very attractive and probably at a valuation which are more like value stocks. In IT sector specifically, the valuations have gone back to where they were during 2008 financial crisis. So I think these are pockets of markets where I see immense value as long as one is able to look over the next few quarters earnings, look at it from a slightly more medium-term perspective. And I think there's a lot of money to be made. After a long time, it's been about we are 6 years into this bull market. We are seeing value emerge in a lot of high quality companies after a very long time in this bull market.
Pankaj, you spoke about IT. So, if we were to look at the earnings season, coming earnings season, what are the kind of metrics that you're going to track for IT, based on which you're going to have a position?
Well, our expectation is that growth is improving in IT sector. It's been 3 years where discretionary spends have not been done in US. So we are seeing early signs of that recovery. Though I must say that it is somewhat early at this point of time and nascent. So our expectation is that the next year will be better for IT companies in terms of growth versus what we've experienced this year, FY26. So FY27 will certainly see a better growth outcome for IT companies, and I expect these companies moving towards at least the larger companies moving towards high single digit, dollar revenue growth probably the year after as discretionary spends in US, come up full time. So I think in that context, valuations look pretty reasonable in the sector. Probably they've corrected, so like they're very attractive in the sector.
Okay. Pankaj, give us a sense on what the gold silver moves are really indicating. I know you're not an expert at gold silver, but how should one read into the moves, and at what point does it start to look attractive if you have a view?
Well, as you said, I'm not an expert, but given the kind of moves a lot of these commodities have had over the last 3 months, 6 months, or 1 year, calendar year 25, gold was up some 60%. The biggest returns that single year returns, annual returns, gold has ever delivered since 1970s. So all of that is a clear reflection of very high degree of financial speculation that has been happening around in all of these commodities and a lot of these asset classes. And probably some of that speculative money is moving out of these, when you get an external shock in the global economy, then it's very normal, it's very usual or normal for speculative money flow to move out of whichever asset class they are, and which is what I think I would read that that's the unwinding of the speculative move that we've seen in a lot of these asset classes, including precious metals. So I would not be a buyer into any of these. I still think that they could have more downsides. In a normalized world, they could have more downsides.
So where is it that you have your largest position, Pankaj, right now? And the stock picker, have you bought anything interesting in the last month and a half?
So, Aisha, in our portfolio, obviously financials is the largest given their dominant weight, and we like the larger banks in India. After a very long time, I've been saying this almost after 20 years, I'm seeing such robust or such healthy asset quality in Indian banking system. Probably after 2006 or 7, across the sector, I think valuation in the sector are reasonably attractive. And probably at a significant discount to the Nifty index. As the growth improves, I think we should see probably, healthy growth coming from banks, and the whole trend of larger banks and private sector banks taking market share away from smaller banks should continue. So I think that's one pocket which we clearly like.
Pankaj, does that include HDFC Bank also? Or have you trimmed?
Absolutely.
Okay.
Absolutely. No, we've been buyers into this fall. So meaning all of us have seen what's been out there. The regulator RBI has come out and said they don't find any regulatory issues with the bank. I know there've been, meaning whatever issues around management and all of that, but these kind of things do happen in larger institutions. So we think this is a good, and as a franchise, I think it's a very formidable franchise. So we are a long-term believers in the bank, and we are owners of the stock. In fact, we've used this correction to buy more into it.
Pankaj, I know we're not completely comfortable speaking stock specific, but because of the concerns surrounding loan to deposit, I'm curious to know, is growth an impediment for a bank like HDFC Bank, just given the kind of size that they have? Because that has been the big drag, right, over the last couple of years. And that's probably why the stock has also underperformed to a large extent versus its peers. Give us a sense as to how you view that.
I'll give you a context first. 2007, when India was a $1 trillion economy, China was a $5 trillion economy, and we had four Chinese banks with a $1 trillion market cap. If we believe that India will get to a $7 or $8 trillion economy, it's my firm belief that there'll be at least two Indian banks which will have a market cap between 800 billion to $1 trillion. And I think HDFC Bank has a high probability of being one of them. I think India can be a $8 trillion economy in the next 7 to 8 years. HDFC Bank, from where it is, about under $200 billion market cap, I think that's a phenomenal returns over the next 7 to 8 years. So I think the long-term prospects for banks, financial sector in India remains very strong. HDFC Bank is a very formidable franchise, given their market share, penetration, distribution, brand, and everything else. Yes, now it's the second largest bank in India, but I still think they have the wherewithal to, deliver mid-teens growth over the next decade, and probably growth ahead of the sector, so which effectively means they'll keep taking market share. In some of the other economies like China, US, we've seen the largest banks have gone to 20% plus market share. HDFC Bank is still about 11-12%. So they still have a lot of market share which they can gain. So longer term, while they've had some of these issues last few years, and that's primarily because of the HDFC merger, but longer term, medium term, longer term, I still think that it's a bank which can deliver very healthy growth.
Okay, thank you so much for that, Pankaj, for coming in and speaking with us. It's an absolute pleasure always to speak with you and get that perspective.
Thank you.
Okay.